On a cold morning in Toronto, a software engineer opens her laptop and checks her LinkedIn messages. One of them is from a recruiter in Austin, Texas. The offer is simple. Same job, same skills, same hours, but the salary is nearly 40% higher, and there's no winter. She stares at the number for a long moment. Then she closes the laptop and goes to make coffee. Because here's the uncomfortable truth most Canadians don't like to talk about. Over the past decade, the economic gap between Canada and the United States has quietly widened, and in many industries, Americans simply earn more. But this wasn't always the case. In fact, for much of the 20th century, Canada and the United States were like two houses on the same street. Similar incomes, similar lifestyles, similar opportunities. If anything, Canadians like to say they had the better deal. Public health care, strong social safety nets, a calmer political climate, the polite neighbor next door. So what happened? How did the two economies that once moved almost in lockstep start drifting apart? Because today, depending on how you measure it, the typical American worker earns roughly 20 to 30% more than the typical Canadian, and that gap isn't shrinking, it's growing. According to data from the OECD and national statistical agencies, U.S. median wages have steadily pulled ahead over the last decade. Meanwhile, Canada's GDP per capita actually declined between 2022 and 2024 when adjusted for inflation, according to Statistics Canada and IMF estimates. In simple terms, the average Canadian is producing and earning less than before. That's not just a bad year, that's a warning sign. Think of the Canadian economy like a treadmill that's been slowly losing power. The belt still moves, people are still running, but across the border, the American treadmill has been accelerating, and after 10 or 15 years, the runners are no longer side by side. One group is sprinting, the other is struggling to keep up. So tonight, we're going to walk through the great divergence between Canadian and American wages, not with abstract theories or partisan talking points, but with real numbers, real policies, and real consequences. Because this gap didn't appear overnight, it formed piece by piece, like cracks in a windshield, and by the time most people noticed, the damage was already done. The first crack was productivity. That's the boring word economists use to describe how much value each worker creates per hour. But productivity is the engine behind wages. If a worker produces more value, they can be paid more. It's that simple, or at least it should be. Since around 2010, U.S. productivity growth has consistently outpaced Canada's. According to data from the U.S. Bureau of Labor Statistics and Statistics Canada, American labor productivity grew significantly faster through the 2010s. By the early 2020s, the gap had become noticeable. The average American worker was producing more output per hour than the average Canadian. Now, imagine two bakeries. One bakery invests in new ovens, faster mixers, and automated packaging. The other keeps using the same equipment from 10 years ago. After a while, the first bakery can produce more bread with the same number of workers, and when the bakery makes more money, it can pay those workers more. That's essentially what happened between the two countries. The U.S. bakery kept upgrading the kitchen. Canada, for a variety of reasons, did not. And that leads to the second crack, business investment. According to data from the OECD and Bank of Canada, business investment per worker in Canada has lagged behind the United States for more than a decade. American companies consistently spent more on machinery, technology, and infrastructure per employee. In some years, the gap was enormous. In the early 2020s, U.S. business investment per worker was roughly 40 to 60% higher than Canada's, depending on the measure, according to analysis from the Bank of Canada and various economic research institutes. That's not a small difference, that's a different economic philosophy. It means American firms were buying the new ovens, the faster mixers, and the smarter software. Canadian firms were often not. Now, here's the uncomfortable part. Investment isn't just about corporate greed or executive bonuses. It's about expectations. Companies invest when they believe the future will reward them, when they see strong growth prospects, when they expect demand to rise, when they think the policy environment is stable and competitive. For much of the last decade, the United States offered exactly that. Lower corporate taxes after the 2017 tax reform, massive tech sector growth, huge capital markets, and a domestic market 10 times the size of Canada's. Meanwhile, Canada faced slower growth, heavier reliance on housing and natural resources, and an economy increasingly tied to real estate activity rather than productivity growth. According to Statistics Canada, housing-related investment became a larger share of total investment over the past decade, crowding out business spending in some periods. In other words, more money went into building houses, less money went into building the machines, factories, and technologies that boost wages. And you might be thinking, okay, but housing is good, right? People need homes. Of course they do. But when an economy starts acting like a giant real estate company instead of a productivity machine, something strange happens. Prices go up, debt goes up, but wages don't necessarily follow. It's like a town where everyone flips houses instead of running businesses. The houses get more expensive every year, but nobody's actually producing more goods or services. So incomes stagnate while costs rise. That's not prosperity. That's a treadmill that keeps speeding up the incline. Now let's talk about GDP per capita. That's the broadest measure of economic output per person. It's not perfect, but it's one of the best indicators of national prosperity. Between 2022 and 2024, Canada's real GDP per capita declined, according to Statistics Canada and IMF estimates. That means, on average, each Canadian was producing less economic value than before after adjusting for inflation. The U.S., meanwhile, saw its GDP per capita continue to grow over the same period. That divergence is rare. Historically, the two economies moved together. When the U.S. grew, Canada grew. When the U.S. slowed down, Canada slowed down. But this time, the U.S. accelerated while Canada stumbled. And when GDP per capita falls, wages rarely rise, because again, wages come from productivity, from output, from value creation. If the economic pie per person shrinks, each slice tends to get smaller. Now let's zoom in on the labor market. According to OECD wage comparisons, median wages in the United States are now roughly 20 to 30% higher than in Canada, depending on exchange rates and definitions. In some high-skill industries, the gap is even larger. Take tech. A mid-level software engineer in Toronto might earn the equivalent of $90,000 to $110,000 US. In Seattle or San Francisco, that same engineer could earn $130,000 to $160,000, sometimes more, according to compensation surveys from firms like Levels.fy and Glassdoor. That's not just a pay bump, that's a life-changing difference. It affects where you can live, whether you can buy a home, how much you can save, when you can retire. And workers notice. According to various immigration and labor studies, skilled Canadian workers, especially in tech, engineering, and finance, have increasingly moved to the United States in search of higher pay and larger opportunities. The U.S. has long had a brain gain effect, attracting skilled workers from around the world, but now it's pulling more talent from Canada as well. It's a quiet migration, no refugee camps, no dramatic news footage, just LinkedIn messages, job offers, and one-way flights. Think of it like water flowing downhill. Talent moves toward opportunity, toward higher wages, toward bigger markets, and over time, that flow can reshape an entire economy. But why didn't Canadian wages keep up? Why didn't productivity rise at the same pace? Why didn't investment match the U.S.? One reason is scale. The U.S. has a domestic market of more than 330 million people. Canada has about 40 million. That difference creates massive advantages. American firms can grow larger, faster, and more profitably inside their own borders. Another reason is the tech boom. Over the last decade, the United States became the epicenter of global technology giants: Apple, Microsoft, Amazon, Google, Meta, and Nvidia, companies with market values in the trillions. These firms pay enormous salaries, especially in engineering and data science roles. Canada has a tech sector, but it doesn't have the same concentration of mega firms with global dominance. And those giant companies act like wage magnets. They pull up salaries not just inside their own walls, but across entire regions. If one company starts paying $180,000 for engineers, every other company has to compete. Wages rise across the board. It's like one bakery in town suddenly doubling pay. Every other bakery has to follow or lose all their staff. Another factor is regulation and market structure. Canada's economy is often described as more concentrated: fewer big banks, fewer telecom companies, fewer airlines, less competition in certain sectors. According to reports from the Competition Bureau and OECD, higher concentration can sometimes lead to less innovation and slower productivity growth. And slower productivity means slower wage growth. It all comes back to that engine. There's also the question of taxes and incentives. The U.S. cut its federal corporate tax rate from 35% to 21% in 2017. That was a massive shift. Supporters argued it would attract investment and boost wages. Critics said it would mainly enrich shareholders. But one thing is clear: business investment in the United States surged in the years following the reform, according to U.S. government data and private sector analyses. Meanwhile, Canadian investment growth was weaker, particularly outside the housing sector. So by the early 2020s, you had a clear pattern. The U.S. invested more, produced more per worker, and paid higher wages. Canada invested less, relied more on housing, and saw slower productivity growth. And here's where the story gets personal. Imagine you're a young engineer in Vancouver. You studied hard, you paid tuition, you landed a solid job. Your earnings say the equivalent of $85,000. It sounds respectable until you realize your counterpart in California is earning $140,000. Then you look at housing. In Vancouver, the median home price is over $1 million Canadian dollars, according to the Canadian Real Estate Association. In many U.S. cities with higher salaries, homes are cheaper relative to income. So now the gap isn't just wages, it's lifestyle, it's savings, it's opportunity. And suddenly, that recruiter's message doesn't look so easy to ignore. This is how economic divergence becomes a human story. It's not about charts or spreadsheets, it's about choices: stay or leave, rent forever or buy a home, build a career locally or chase opportunity abroad. And if enough skilled workers leave, the problem compounds. Productivity slows further, investment looks less attractive, wages stagnate, more workers leave. It becomes a feedback loop, a slow, quiet spiral. Now, to be fair, Canada still has strengths. It has strong institutions, a stable banking system, and relatively low inequality compared to the U.S., according to OECD measures. Healthcare is publicly funded, social programs are more robust. For many people, that trade-off is worth it, but the wage gap is real, and it's growing. Over the long run, economies that invest more, innovate more, and produce more per worker tend to pull ahead. That's the lesson repeated across decades of economic history. It's what happened between Western Europe and the United States, between Japan and South Korea, and now, increasingly, between Canada and the U.S.
So, what's the verdict? Over the past decade, the United States didn't just grow, it accelerated. It poured money into technology, capital investment, and high-productivity industries. Canada, meanwhile, leaned more heavily on housing, population growth, and resource sectors, while business investment lagged. The result is a wage gap of roughly 20 to 30% at the median, slower productivity growth, and a steady flow of skilled workers heading south. In economic terms, it's a divergence. In human terms, it's a series of quiet decisions made by millions of individuals looking for better pay, better opportunities, and a better future. And here's the warning. Economic divergence doesn't happen all at once. It happens slowly, quietly, year by year. One missed investment cycle, one underfunded industry, one lost worker at a time. Until one day you wake up and realize the neighbor next door isn't just a little richer, they're living in a completely different neighborhood. If you're Canadian, the question becomes simple and uncomfortable. Do you stay and hope the gap closes, or do you follow the opportunity south? And if you're American, there's a different question. Is this advantage permanent, or just another chapter in the long, unpredictable history of economic rise and fall? Because in the end, wages are just a reflection of deeper forces: productivity, investment, innovation, policy choices, cultural attitudes toward risk and growth. And those forces can change. So the real story isn't just why Canadian wages fell behind the US, it's whether Canada can close the gap before an entire generation decides the answer lies somewhere else. If you want to understand where this divergence leads next, keep an eye on the battle for talent, investment, and productivity, because that's where the next chapter of this story will be written, and it might look very different from the one we just told.